Welcome to Landco. I want to talk about the differences in real estate and capital. Many times we think in terms of the analogy an automobile. An automobile without gasoline doesn't do us much good. You can look at it, but it doesn't function for its intended purpose. It's no different in real estate, though there is a difference in the grade of capital, and that all has to do with the niches that we're trying to fill. There are very, very different needs in real estate, and as such, there are different needs of capital to go into the real estate to make it a successful investment. The niches in the marketplace range from private individuals and their capital needs all the way out to pension funds and private equity real estate funds and their capital needs, and the way they deploy that capital in the real estate that is the chosen investment. So the couple points I'd like to make: the cost of capital is really only known after the investment concludes its cycle. And this may seem a little bit strange to all of us familiar with interest rates and target hurdle rates and what have you. But the reality is the opportunity cost of getting involved with a particular investment is not known until the duration of an investment cycle closes, because we essentially don't know what we may have given up until the cards reveal themselves. So that I consider a cost of capital, as well as the debt costs and the way that we achieve whatever element of financing we may wish to in a particular investment. We don't know what the interest rate market is going to do, or what other finance opportunities may be coming along the way. So by obligating ourselves to a particular investment, we have precluded ourselves from becoming involved in another. Equity, not a lot different. Equity is typically structured with a coupon or preferred return, as many call it, and then some kind of a split of profits at the conclusion of the cycle of an investment. We can't know what that conclusion is going to look like until we get there. So in the end, cost of capital, as important of a factor as it is, we're estimating what it's going to be. The takeaway for this, for me, is be familiar with the conventions in the markets and the products that are available today to be used, and not always hesitant to try new things. Sometimes we're precluded from different aspects of capital, building the capital stack for various reasons, restrictions, what have you. But there's never a shortage of there's never not a need to be creative and to think in terms of what can be done to try to accomplish our goal and investment objective. For my purposes, I tend to place flexibility and low cost of capital as a highest priority. Yes, it's interesting to focus on target returns, and that's fine as well. But in the end, it's the market that's doing the work. And so what we want to do is remain in the marketplace with as much flexibility as we have to adjust to differences that may and almost certainly do come along the way during our investment duration. And do the hard work. Thanks for joining us today.